Welcome back to Switzer. Our next guest is one of Australia's leading investment forecasters and a regular on the Switzer show. He's been a professor of econometrics and was a chief investment officer at Commonwealth Bank Private and is now the executive director of Woodhall Investment Research. Dr. Ron Bewley, welcome to the show.
Pleasure.
How are you, mate?
I'm really good. Good to see you here in the seat.
Fantastic. Well, Ron, you're very much one of the show's favourite contributors, and I know Peter thinks very highly of you. As a forecaster and a leading investment strategist in Australia, you've added a new dimension to the way you are going to forecast in 2014, which we're keen to know about. But just to refresh, what is your process for investment forecasting? What's changed? And what do you see for investors in 2014?
Good question. So I don't do what I think most other people do, and that makes me a little bit different. I steal other people's ideas. So I take Thomson Reuters data feed. There are 200 stocks. There's about 10 or 12 analysts for each stock, and they all make forecasts of earnings and dividends. I have my little magic tricks that put all those together, and then I get, based on their forecasts, I get sector forecasts, so what are going to be the capital gains and the dividends for each sector, and then I can aggregate those up into what the market will do. And I haven't changed that. I started that about 10 years ago.
Yep.
When I left the Commonwealth Bank and started up again, I reinvented the whole thing. The same principles, but better formulae.
Yep.
So basically what I'm doing is living off the broker forecast, and if they're wrong, I'm wrong.
Yep.
And I'm happy to. So I'm summarising other
So you
people.
get the broker forecast from a Reuters or something like that?
Very expensive, but I get it all the time.
Yep.
And the thing there is that they actually get guidance from the companies. They're not just out there on their own. The companies give them a hint about what the earnings and dividends are going to be. So,
Sure.
So you're really getting all of the companies, all of the brokers and broking analysts, and you put it all together. So it's the best summary I can get using proper academic principles to find out where the market should be going. And it's done reasonably well, to be honest.
How'd you do last year?
Close to spot on. We'll see in a moment.
Okay, great.
But how you look at it.
So,
It's
and what's the
almost
change?
embarrassingly close. Well, I didn't want to change. If something's not broken, you don't try and fix it. But I realised there was something missing, and this is over the last few weeks.
Yep.
And actually, it came out of a comment your dad made.
Okay.
Oh, sorry, I should say Peter.
No, he's my
I've known
dad,
him for
so
years.
absolutely. You guys go way back.
Yeah. But he made a call. It was a gutsy call early on last year for 5,500.
You almost got there.
No, now let me take that one. Mine was 5,150, so we teased each other. But everybody else was below 5,000. They were going for a flat market. So Peter was right out there. I was out. If it hadn't been for Peter, I would have been the whatever. And it got to 54, 51. But that was in October. And I was looking bad, but then it came down to actually below my 51.50, then it was up again. So the market shoots all over the place. And I think people have been asking the wrong question. They don't mean, what's the number going to be on New Year's Eve? Peter was making the call that it's going to get up there. And so I think he was right in a sense. So therefore I said, how do we make people happy? Because the problem with being a technician such as myself is I do my mumbo-jumbo, and I don't know whether people understand what I'm doing.
Sure.
So what I'm doing now is I'm actually predicting the maximum in a year, and I'm predicting the minimum in a year, so the range.
Yep.
Not caring what the last day is going to be.
You're saying it's high point, and you're going to look at
So
where it is, where it can get to, and where it ends
so
up,
where
rather than
things
just
be
where
at,
it starts and where it ends.
It's going to be that far out at the end.
Yeah.
But you can actually forecast the high and the low with more accuracy.
Yep. Okay.
Which is fun.
So what we've got is we've got some charts
Yes.
which are going to demonstrate
it
your
works.
view for 2014 and explain what this change is.
So we'll go back to 2 years ago first and very quickly go through the last 2 years so we can see it. So
Absolutely.
If we can have chart one.
Chart one, so chart one's up here now.
So you'll see the ASX 200 is light coloured because I don't want to focus on that. And it's sort of going up. And remember in the beginning of 2012, people were scared stiff after the AAA rating was lost from America. Europe was going into chaos.
Yep.
So to actually say that diagonal red line was a forecast was fairly brave.
Yep.
But what I've now added is the high, which is the horizontal red line.
Sure.
And the low, which is the dotted line.
Yep.
And you can see it just exactly touched the bottom dotted line. Yep. So it turned out to be a perfect forecast because the thing is, if you have to predict the end of year, that's a specific day.
Yep.
But the high, it doesn't matter which day it is.
Yeah. So Ron, we are getting a little short on time, so we might go to the next chart, chart two.
So we now build that up and add on a bit more. And so we've got
chart two will be coming up.
Yeah. So you see now, the low's gone up, the high's gone up, and again, the high calls just right.
Yep.
So it's working well, and it's worked better than the end-of-year forecast. In some sense, it's more informative to me.
Definitely.
Because that's what I was trying to do.
Sure.
So then if we did the
Chart
next one,
3,
which is the question you did before, you'll see that's the year just gone with the black solid line.
Chart 3 is coming up.
And you'll see that it's just below Peter's 5,500. It's 5,450.
Absolutely.
So again, it sort of worked. And in some sense, that's what Peter, I think, was saying. In some sense, that's what I've been thinking about. I've now formalised the structure. And the things that determine what those numbers are, you've got to be able to forecast volatility.
Sure.
You've got to be able to forecast the diagonal line, the trend. And the interaction of the two plays a big part.
Okay. So let's see chart 4, which is the call that everyone wants to know you're going to be making.
So the call, let's just focus on the middle line. So the average volatility is 12.5%. So that's what I'm going to stick in my model, and I have to put my glasses on to read it. I'm sorry. So volatility doesn't affect the end of year. So I'm going for 58.50, which is below a lot of people. It's in the pack now. But the high is 61.50. So 300 points higher.
That's the change you're making now. You're looking at the maximum we can get to and where it ends up.
I'm not running away from my 58.50. I'm just saying on the way there's going to be 300 points higher. Or if it turns out to be a really bad year, it could get down to 51, but not below. So it helps me manage my risk. And so if along the way I see it's going to 4,900, I know there's something wrong.
Sure.
Or if it's going way, way above, I start taking profits. So if it gets to 6,200, 6,300, something funny is going on. So it's going to give me an extra dimension to manage my money.
And the volatility side of things, how does that work?
Well, that's a different story about how we do that. And all these slides are on my website for anybody who wants to watch it, woodhall.com.au. That 10% is actually current vol. It's slightly low. So it's how much of the day-to-day variation is dominating the trend.
Sure.
10 is low, 12.5 normal, 20 is like really bad. And of course, this range spans out the more volatile the situation is.
So 5850 by end of year, but we think we'll get to a high of 6150.
Yeah, but the 5850 has to be woolly because it could be the day before, the day after, or the week before, week after. But I'm going to put more weight on my 6150.
Fantastic. And you're going to be back on the show in a month's time, and you can talk about this in more detail. We can also find all this information on your website. It's very valuable stuff.
There's some notes there as well, so a story that goes behind this.
Absolutely. Well, that's fantastic, Ron, and I really appreciate you coming on and giving us your expert insights. They're very much valued on the show. Thank you. And we've actually just got a little bit more time, I found out. So we do have one more chart 5, which is fantastic. Always good to get a bit more time with you. We are having some slight technical issues here, and I've found us another couple of minutes. So we've got the key information in relation to the market. You put some calls out there, which is fantastic. What we've got now, though, is your outlook on the sector forecast for 2014. So what's this chart telling us?
Well, this splices into the other thing. We think it's going to be a good year, but not spectacular.
Sure.
So how do we get there? Well, if you look at the right-hand column of this table at the bottom, you've got 10% of rounded the numbers, so it's easy to see.
Capital gain,
for the year ahead.
So 14.6%, including yield, is your expectation for the ASX 200.
And the minus 1% is mispricing, so it's slightly underpriced at the moment.
So things are all fine. Index.
But then we can split that up into all the different bits and pieces, and you'll see that energy is cheap. Minus 6%. Property is cheap, minus 4%. Utility is a bit cheap at minus 3%. So they'd be good buying opportunities now if you get the right stocks and we look for the ones with the good
You're seeing a lot of value in energy and industrials.
Yes. Industrials has been bursting forward. That's been the real ace, probably the last 3 or 4 months, and probably because of the dollar coming down. So the earnings forecast have been upgraded, and that's looking really tasty. So getting things that would be exposed particularly to America and the rest of the world as they grow would be good. And you look at the cap gains forecast, 29 for energy and 22
industrials, we're talking stocks like Toll, Brambles.
Asiana and things like that.
Asiana,
Companies like that are really maybe going to get there. I don't keep all the stocks in my head. I have to look them up off the list when I do it. Of course,
absolutely.
But you see materials has come right down. You see that was up at 20% before. That's down to 9 now. And you saw the mid-cap iron ore miners suffering a bit today. Some big pullback. So that's not as tasty as it was. So there's been a rebalance, mainly into industrials and energy. But you'll see the beautiful set on the bottom, the other discretionary staples, health and IT. So this sort of cyclical stuff coming through, or some of them are cyclical. They're all nice and solid double-figure gains, and they've got quite decent dividends. So given that financials now has got not far to run. There's a dividend constraint in there. They're on about 5.5%. It won't go below 5.1%. So the price of Commonwealth Bank can't go up much unless the dividends start to rise. So really what it is a play, do you want dividends or capital gains, or do you want both? And then playing it together on these. And as you know, from time to time on the Switzer Super
report, which you write for?
I put in bits and pieces about how they stick together. So some of the old papers there, we'll talk about how these things all fit together.
Well, Ron, that was some fantastic forecasting, and we'll definitely be watching your views into 2014. Great to get an extra 3 minutes with you, and look forward to talking with you very soon, mate. So thanks for coming on.
Pleasure.
And that's the show for tonight. If you want to read our thoughts each morning at the close of Wall Street, check out our website, switzer.com.au. If you want to get our thoughts on super, visit switzersuperreport.com.au. And if you've got any questions for me or ones you'd like me to put to an expert, email me, switzer@skynews.com.au, or follow me on Twitter, and the handle is @MartySwitzer. I'm Marty Switzer. Thanks for watching.